Welcome to the debate. Today we are opening the black box of the financial world, private equity. We're digging into a comprehensive educational series from asset manager Neuberger Berman that really dissects the mechanics, the strategies, and the stark reality of this massive asset class.
And the central question we are wrestling with is, I think louder now than it has been in maybe 20 years. Is private equity still the engine of superior returns and active management? Or, now that the era of cheap money is over, is it just an opaque, illiquid trap where the golden era is firmly in the rearview mirror?
I think you're already painting a pretty bleak picture there. But I'll take that challenge. I represent the position that private equity offers a structural advantage, active ownership, patient capital, that public markets just cannot compete with.
And I represent the view that while the mechanics are, they're clever, the risks, specifically the J-curve, the liquidity constraints, and manager dispersion are being glossed over. The playbook that worked for the last decade is frankly broken.
Okay, let's dive in. To understand why institutional portfolios have moved from treating private equity as, a niche hobby to a cornerstone allocation, you have to look at the sheer size of the opportunity. The Neuberger Berman data highlights a statistic that it stops people in their tracks. In the U.S. alone, there are over 18,000 private companies with revenues over $100 million.
18,000. That's a big number.
Exactly. Compare that to the public stock market. There are roughly 2,800 public companies of that size. That represents a massive shrinkage. If you restrict yourself to public markets, you are effectively ignoring 85% of the U.S. economy. You're fishing in a shrinking pond.
Look, I don't dispute the geography. The companies are there. My concern is the toll booth you have to pass through to get to them. You talk about accessing the real economy, but the cost of admission is steep. The standard 2 and 20 model, a 2% management fee regardless of performance, plus 20% of the profits, is a massive drag on net returns. In a world of 5% interest rates, that fee structure is a much heavier burden than it was when rates were zero. I mean, you have to generate incredible gross returns just to match an index fund after fees.
But you're focusing on the gross cost, and I'm looking at the net result. Historically, top quartile private equity managers have outperformed public markets by over 1,000 basis points. That's 10% over long horizons. That isn't a rounding error. That is significant alpha generated through active ownership. When you buy a stock, you're a passenger. When a PE firm buys a company, they are the driver. They control the board, they change the strategy, they upgrade the talent. They aren't hoping the stock goes up, they are making it go up.
Active ownership is a great marketing term. It really is. But let's peel that onion. You're citing historical outperformance that occurred largely during a period of, declining interest rates. It is very easy to look like a genius when you buy a company, slap 5 times leveraged debt on it, and then watch the valuation multiple expand simply because money got cheaper. That isn't operational wizardry, that's just riding a macro wave. The Neuberger Berman material itself notes that the easy money era is over. The wind is no longer at your back.
And I'm glad you brought that up, because that is exactly why the current environment favors the argument I'm making. You're right, the beta of cheap debt is gone. You can't just financial engineer your way to a 20% IRR anymore. But that just elevates the importance of the skills-based levers the report discusses. The easy money is gone, which means the dumb money is going to fail.
Okay, walk me through that because the math looks much harder to me now.
Okay, look at the value creation bridge for recent co-investment composites included in the source material. This is fascinating data. It shows that in the current environment, deal teams are actually underwriting a 14% value reduction due to multiple compression. They expect the asset to be worth less on a multiple basis when they sell it than when they bought it.
Which proves my point. The tide is going out. You're starting the race 10 yards behind the line.
No, it proves they are being realistic and conservative. To hit their return targets now, the data shows 93% of the value creation must come from top-line revenue growth and EBITDA expansion. They have to actually grow the business. They can't rely on buy low, sell high. They have to buy fair, work incredibly hard, and sell fair.
That requires the operational expertise of a specialized general partner, a GP, who knows the sector inside and out. A distracted public board worrying about quarterly earnings calls just cannot execute that kind of transformation.
I appreciate the optimism, but let's look at what working incredibly hard actually entails in this market. You're asking these managers to swim upstream. You mentioned EBITDA, earnings before interest, taxes, depreciation, and amortization. Growing that is hard enough, but now the I in EBITDA, interest, is eating up a massive chunk of cash flow.
That's why leverage levels are coming down. The days of 8 times leverage are largely gone. We are seeing more conservative capital structures precisely because interest costs are real again.
Marginally. But this brings us to the structural issue that really scares me the most, the J-curve in liquidity. You talk about patient capital, but there is a fine line between patience and paralysis.
The J-curve is simply the investment life cycle. It's a known feature, not a bug. You commit capital, cash flows are negative in years 1 through 4 as you buy companies and pay those fees, and then they turn positive in the harvesting period. It's the price of building value. You can't bake a cake without buying the ingredients first.
The problem is that the oven is taking a lot longer to heat up. For many investors, that J is starting to look like an L, a flat line. The exit environment has fundamentally changed. The source material notes that distribution rates, cash coming back to investors, have dropped to 10 to 15% of the net asset value. Historically, a healthy market is distributing 20 to 40%.
But that's a cyclical phenomenon, not a structural flaw. M&A activity slowed down because of the rate shock. It's already starting to thaw. IPO markets are opening up, and strategic buyers are coming back to the table.
Sure, but the impact on the investor is immediate, and it's painful. This introduces the denominator effect. Imagine a pension fund. Public markets drop, so the value of their stocks goes down. But their private equity portfolio is marked to model, so it stays flat. Suddenly, they are overweight private equity. They are liquidity constrained. They can't rebalance. They can't access their cash. You call it patience, but during a liquidity crunch, it feels a lot like a trap. The illiquidity premium investors are supposed to earn is largely compensation for the risk of not being able to access your own money when you need it most.
I see why you characterize it that way, but let me give you a different perspective on liquidity. The market is evolving to solve exactly this problem. We are seeing a massive rise in the secondary market, particularly GP-led secondaries. This allows general partners to hold onto their best assets longer while offering liquidity to investors who want out. It's no longer a binary hold or sell world.
GP-led secondaries are a double-edged sword, though. Yes, it provides an option. But think about the signal. The GP couldn't find a strategic buyer like Google or Microsoft, and they couldn't IPO at the price they wanted. So they sell the asset to another vehicle they control. It feels like passing the parcel.
That's a cynical take. It's often about retaining winners. If you have a star asset compounding at 20%, why sell it just because the fund clock struck year 10? Compounding shouldn't have a deadline. By moving it to a continuation vehicle, the GP can continue to drive value, and existing investors get a choice. Take the cash now or roll over and keep riding the winner. That is flexibility, not passing the parcel.
It's flexibility at a price, usually with a fairness opinion. That is debatable. But let's shift gears to the trends aspect. You mentioned fees earlier. I know you think the industry's evolving there too.
It absolutely is. The rise of co-investments is dismantling the traditional fee structure you hate so much.
Dismantling is a very strong word.
It's accurate. The source material explains that in a co-investment, you are investing directly into a portfolio company alongside the GP. And typically, there is no management fee and no carried interest on that specific capital. If you blend that with your primary fund commitment, your average fee load drops significantly. You can also be tactical, overweighting software or healthcare if you believe in those sectors, rather than just buying the blind pool.
That's a compelling argument on paper, but have you considered the risk of adverse selection?
How so?
Think about the incentives. Why is the GP inviting you into the deal? Is it because it's such a slam dunk, they want to share the wealth? Or is it because the check size is too big for their fund concentration limits? Or worse, is it a deal that is slightly riskier, so they want to spread the risk around? I mean, sourcing is the hardest part of this business. Unless you have a massive team doing due diligence, You are relying entirely on the GP's underwriting. You might be getting the deals they didn't want to keep 100% of.
That ignores the reality of relationships. The source material clarifies that GPs use co-investments to reward their best limited partners. It's relationship currency. They aren't dumping bad deals. They are solidifying relationships for the next fundraise. And for the investor, it mitigates the J-curve we discussed, because that money goes to work immediately. There's no blind pool risk. You see exactly what asset you're buying.
Fair enough, provided you have the team to analyze it. But let's talk about the other trend, democratization via evergreen funds. This is being sold as the solution for the individual investor. Monthly subscriptions, quarterly redemptions. It sounds like a mutual fund, but it holds illiquid assets.
And it opens the asset class to people who can't write a $5 million check. Evergreen funds remove the operational headache of capital calls. You are fully invested on day one. It compounds continuously. It allows individual investors to access that same 18,000 company universe we discussed at the start.
I'm sorry, but I just don't buy this semi-liquid promise without a massive asterisk. These funds have gates. If the market turns and everyone wants their money back at the quarterly window, that window slams shut. We've seen this in real estate funds recently. Furthermore, to manage that liquidity, evergreen funds have to hold a sleeve of cash or liquid securities. That creates cash drag. You aren't getting pure private equity returns, you're getting diluted returns with a liquidity feature that might fail exactly when you need it.
It's a trade-off, certainly. You trade some pure return for access and convenience.
But for a long-term investor, the ability to compound without the friction of fundraising cycles is a structural benefit. But I want to pivot to something that is changing the underwriting equation entirely: artificial intelligence.
This is the new buzzword, but in PE, I actually find it terrifying.
Terrifying. I see AI as the ultimate lever for the active ownership model I defended earlier. If a PE firm owns a portfolio of 50 companies, they can centrally mandate the implementation of generative AI. They can strip out costs, automate back office functions, and optimize pricing across the whole portfolio. A public board takes years to debate these changes. A PE firm can implement them in quarters. They can force efficiency.
That's the optimistic view. I come at it from a risk perspective. The source material lists key underwriting factors for a buyout. The holy grail is stable, predictable cash flows. That is what allows you to put debt on a company. AI introduces massive volatility to business models that used to be boring and stable.
You mean disruption risk?
Exactly. If you are buying a B2B software company or a business services firm, you have to ask, will a large language model wipe out this company's value proposition in 3 years? The moat question has become almost impossible to answer. If the target company doesn't have a proprietary dataset, if they are just a wrapper around a public model, their terminal value might be zero. How do you lever up a company when the revenue stream might just evaporate due to a technological shift?
That's why the diligence phase is critical. But I would argue PE firms are better positioned to assess that risk than public shareholders. They have access to proprietary information. They can see the code. They can interview the engineers. In the public market, you're relying on the CEO's prepared remarks. PE firms can identify the businesses that can capitalize on AI to disrupt their own industries, rather than being the victim.
Or they catch a falling knife. The risk premium required to hold an asset susceptible to AI disruption should be massive. And I'm not sure current valuations reflect that. Valuations have moderated, sure, but they haven't collapsed.
They haven't collapsed because high-quality assets are scarce. The flight's quality mentioned in the source indicates that money is chasing the few businesses that have proven resilience. And frankly, AI is also helping the GPs find those assets. We are seeing firms use AI for deal sourcing, scraping data to find founders before they even hire a banker.
That is true. Using AI to find the needle in the haystack is a legitimate use case, but I worry that when they find the needle, they are paying a price that assumes perfection.
Let's bring this to a close. We've covered the mechanics, the liquidity, the co-investments, and the future risks. Where do you land on this?
My position remains one of extreme caution. The structural advantages you cite, active management, control, they're real, but they are priced to perfection. The easy money era masked a lot of mediocrity. Now that rates are higher, the dispersion between managers is going to blow out. The source material mentions a 15% performance gap between top and bottom quartile managers. That is the difference between a compounded fortune and a dead investment. If you can't access the top tier, you are better off in a low-cost index fund. The risks of illiquidity and fee drag are just too high for average performance.
That's a valid warning on manager selection. Average is over. But I remain convinced of the asset class's necessity. You simply cannot ignore half the economy, the private half. The sheer number of opportunities, combined with the ability to execute operational change away from the quarterly spotlight, provides a diversification benefit that is essential for a modern portfolio. Whether it's through fee-efficient co-investments or accessible evergreen structures, private equity remains the best tool we have for long-term capital appreciation.
It's a tool, sure, but it's a power tool. You can build a house with it, or you can cut your hand off.
On that graphic note, we will leave it there. Active diligence isn't just a recommendation, it's the only way to survive.
Absolutely.
Thanks for joining the debate.
Thank you.